The US economy is in a downturn. The concerns were exacerbated by jobs data revealing that the US economy added far fewer jobs than initially reported, sparking concerns about the state of the labor market. Now, recent data from the US Labor Department reveals that the US added 818,000 fewer jobs in the year ending March. The change means that roughly 2.1 million jobs were created in the US in the past fiscal year, compared with about 2.9 million initially thought of before the revision. Now, job growth averaged about 174,000 a month in the year ending March, a drop of 68,000 a month from 242,000 jobs earlier reported. This significant revision has important implications for policymakers, businesses, and job seekers. But does the data mean that 1 million jobs were lost in the year? No. The new figure does not represent job losses, merely an estimation of how many jobs were created in the period as opposed to initial estimates. But the downward revision of job numbers has several implications for the US economy. The report marks the largest downward revision since 2009 and suggests that the labor market has begun losing steam earlier than initially thought of. The unemployment rate in the US also recently climbed to a new high of 4.3%. The share of American workers, both employed and unemployed, looking for a new work rose to its highest level in a decade in July, even as hiring has largely come to a halt. Now, lower job growth might reflect challenges in employment recovery, especially if the revised figure show a slower rebound from previous economic downturns. Now, fewer jobs than previously thought of also indicate weaker economic growth. Job creation is a key indicator of economic health, and a slowdown can signal broader issues within the economy, such as reduced consumer spending or lower business investments. All of this will have an implication on Fed's monetary policy stance. The Federal Reserve closely monitors jobs data to guide its monetary policy decisions. Lower job growth might influence decisions on interest rates and other economic policies. A weaker job creation could lead to Fed adopting a more accommodative stance to stimulate the economy. Economists say that the latest jobs data makes it all but certain that the Federal Reserve will cut benchmark rates at its September 18 meeting. The only point of difference in the view will be whether the cut will be 0.25 percentage points or 0.5 percentage points.